Chapter 24 is looking at performance evaluation as well as responsibility accounting. So one of the things we're going to be looking at is how, when we're evaluating managers, do we hold managers accountable when they have authority over making decisions about investments. Some managers can only control cost, and some managers are able to just control their cost as well as sales, right? So both of those managers, cost center and profit center managers, we can evaluate them using performance reports that we learned in chapter 23, right? Because we can evaluate actual sales and actual cost to our budgets. Great way to evaluate the performance of those managers. But when we have a manager who is not only responsible for profits, revenues, and costs, but they are also responsible for using business or company funds to invest in assets that are supposed to turn around and help the business operate, how are we going to hold them accountable for making wise investment choices? And one of those ways we can do that is through a couple tools. One is the return on investment, and the other one is residual income. So that's what this problem is going to have us working with to evaluate whether a manager's investing decisions were well in line with what the company's needs and desires are. So Megamart has provided the following information on two investment centers. So they have electronics and sporting goods. And the managers of both of these investment centers are responsible for not only the revenues and costs, but they're also responsible for investing into assets for those two divisions. We're going to compute the return on investment for each center, and we're going to compute the residual income. So let's first do the return on investment, evaluating which center is most efficient at using its assets to generate income. The formula for return on investment is to take the investment center's income and divide by the average assets that have been invested within that center. So for electronics, we have an income of 2.88 million, and for sporting goods, 2.4 million. We're going to divide by the average assets within each of those divisions. Income divided by assets, 18% return in electronics, 17% return in sporting goods. So evaluating it, obviously a return that is higher. In other words, our income as a percentage of our investments is higher. That's what we want to see. So evaluating these two, the manager of the electronics is doing a little bit better, and that center is more efficient in using its assets to generate income. Now, re-evaluating those two divisions using residual income, which is going to be the difference between their actual income and what the target income is. Okay. This company has a target income 12% of average assets. In other words, they want their income to be 12% of the amount invested in their assets. So if we take each center's income and then we subtract the target income, the target income is going to be the amount of the assets times their target income, which is 12%. Multiply that out. 16 million times 12% and 12 million times 12%. The difference between the electronics actual income and its target income is 960. And sporting goods, actual income 2,040,000, target income 1,440,000, residual income of 600,000. So it looks like the electronics have better residual income as well as a better return on investment. So I would say the electronics manager is working a little bit better at controlling investments and their usage of their investments in generating income for the centers. Okay, so then assume that the electronics center is presented with a new investment opportunity that will yield a 15% return on investment. Should the new investment opportunity be accepted? And the answer is yes, because if they're going to get a 15% return on investment that exceeds their target return, then the answer would be yeah, go ahead and invest in it. Okay, so those are a couple tools that enable us to evaluate a investment center manager. This next problem has us working with kind of I don't know, I feel like we're kind of going off on a tangent a little bit here, but assigning joint cost, right? So if we're trying to assign costs to products or to departments, and there are costs that are incurred jointly by two departments or by two products, we have to have a way to allocate those joint costs to the two different divisions, departments, or two different products. Okay, so there's multiple ways to do it. One of the ways to do it is based off of the value of the ultimate department or the value of the inventory items, the products that are being produced. So Home Properties is developing a subdivision. It includes 600 home lots. Of those lots, 450 are in the canyon section. They are below a ridge and do not have views of the neighboring canyons and hills. The other 150 lots are in the hilltop section and offer unobstructed views. The expected selling price for each canyon lot is 55 grand, and each hilltop lot is double that at 110. The developer acquired the land for $4 million and spent another $3.5 million on street and utilities improvements. We want to assign these joint land and improvement costs that totaled $7.5 million to the two different products, to the canyon section lots and the hilltop section lots. Okay, so total costs incurred were $4 million to buy the land, $3.5 million to improve, create streets, and put in the utilities. So the developer has total costs of $7.5 million for all 600 lots. And they're trying to figure out how do we allocate those costs to the canyon lots and the hilltop lots. Okay, so total costs we need to allocate $7.5 million. We are going to do it based off of the total value of the end product. So if we have 450 canyon lots that can be sold for $55,000 each, total value of all of those canyon lots is $24,750,000. The hilltop lots, we have 150 that can be sold for $110,000. Total sales value $16.5 million. The total market value of all products that will come out of this joint land is $41,250,000. So we're going to take each product or each item's value of the total sales value 24,750 divided by 41,250, 24,750 divided by 41,250. 60% of the total sales value is attributable to the canyon lots. The hilltop lots, $16.5 million divided by total sales value of all lots. See if I can get the numbers in here right. Oh my goodness, I'm having trouble typing right now. Divided by 41,250, 40%. Okay, so we have each product or each inventory item percentage of the total value of all the cost or of all the value of the land that they bought and then developed. We are going to allocate 60% of the joint cost to canyon and 40% of the joint cost to hilltop. So joint cost is $7.5 million, 60% or $4.5 million will go to canyon, and the other 40% will go to Hilltop. Right, so now we have a way to allocate the $7.5 million of cost incurred to buy and develop the land that they will ultimately be able to sell to Hilltop and Canyon lots. We're going to allocate the joint cost to the products, $4.5 million to Canyon, $3 million to Hilltop. Right, so that is going to help us price those lots better when we have a good idea of what the true cost of those lots are. Okay. All right, last problem in this chapter is going to have us looking at performance reports. Right, so we looked at a performance report in the previous chapter, and we first did a problem earlier in this chapter that looked at ways we can evaluate managers of investment centers. We're going to go back now and revisit preparing a performance report for managers of departments. And one of the key topics we need to focus on is only evaluating a manager based off of things that they can control. So if they can't control revenues, we don't include it on their performance report, right? If they can control some costs but not all, we're only going to include costs of their department that they have control over. Okay? So taking a look at this problem, Anna Perez is the plant manager of Travel Free's Indiana plant. The camper and trailer operating departments manufacture products and have their own managers. The office department, which Perez also manages, provides its services equally to the two operating departments. Each performance report includes only those costs that a particular operating department manager can control: direct materials, direct labor, supplies, and utilities. The plant manager, Anna, is responsible for the department manager's salaries, building rent, office salaries other than her own, and all other office costs, plus all the costs controlled by the two operating department managers. Okay, so think about this as you've got the two departments, you've got camper and trailer. The managers of those two separate departments are only responsible for controlling materials, labor, supplies, and utilities. Anna, the plant manager, is in charge of those department managers, the camper and the trailer salaries, their building rent, the office salaries, not her own, but others' office salaries, and other office costs. Plus, she's also held responsible for costs that are controlled by the two operating department managers, right? So as a supervisor, you have to be responsible for not just what you directly control, but you're also going to be held accountable for your subordinates, things that they're supposed to control, right? You're supposed to help manage them. So what we're going to be doing is we're going to be preparing a responsibility performance report that only lists costs controlled by the manager of the camper, manager of the trailer departments, as well as the manager of the Indiana plant. All right, so what they've given us here are annual budgets along with actual costs for the two operating departments. Okay, so here we have campers and trailers budget, campers and trailers actual results for the year. They have listed all of the costs incurred in those departments. They've also given us the office department, right, which is the plant manager in the main office, the plant manager's salary, other office salaries, and other office costs. So these costs are incurred by the office, the plant manager controls, and they are costs that are incurred to help oversee the two departments, operating departments, campers and trailers. So we got a lot of information here, but I wanted to try to simplify it as much as I can. Okay. So let's prepare a responsibility accounting performance report for the managers of the two departments, the camper and the trailer. So we're trying to evaluate how those managers did for the year in controlling the costs that they have control over. The only costs that they can control are direct materials, direct labor, supplies, and utilities. So the only costs that I'm going to put onto their performance report are going to be direct materials, budget and actual, direct labor, budget and actual, supplies used, budget and actual, and utilities, budget and actual. So I'm pulling these numbers directly out of the given information. The camper department, if I compare budgeted materials to actual, actual was less under budget. Right? So they didn't really identify here, but I would say that is favorable. Right? Labor, actual exceeded budget, unfavorable. Actual supplies exceeded budget, unfavorable. Utilities were less than budget. This is favorable. Materials, we were under budget, favorable. Direct labor, over budget, unfavorable. Under budget for supplies and under budget for utilities. Okay, so now we have a great way to evaluate the performance of these two department managers, right? So this will direct Anna, the plant manager's, attention to things that the managers are doing well in their department and things they can work on. Then Anna is going to be held accountable by her superior, which is probably somebody in the region, the regional director. So when we're evaluating the plant manager's performance, we're going to include things that the plant manager has control over, which are department manager salaries, building rent, office salaries other than her own, and all other office costs, plus the cost incurred by the two operating departments. All right, so here we have the department manager salaries, budget and actual, building rent, budget and actual, other office salaries and other office costs, budget and actual, and then the total cost, budget and actual for the two departments. So now when we go through and evaluate, the salaries actual exceeded the budget, unfavorable. Building rent actual was less than budget, favorable. Other office salaries less than budget, other office costs less than budget, both favorable. Camper department, actual cost exceeded the budget, unfavorable. Trailer department, actual total cost under budget, favorable. Okay. So now we can evaluate how well each of these department and plant manager division, how well they control their costs and how well the plant manager supervise the departments. Okay, again, kind of hard for us to do anything more with it at this point other than recognize that this will help direct attention to identify things that went well, things that need to be addressed and improved. All right, hope this helps.